services and mortgage frontline, we're still trying to do the best for everyone, be that lenders, solicitor and valuers helping you, you helping your clients, and indeed your clients helping you. While our social and business lockdown continues and seems likely to do so for some time, at Mortgage Juicer, we're endeavouring to help supply you with both valuable information and market insight as and when we get it. And trust me, for the team working behind the scenes here, that really is a tough job. So it delights me that this afternoon we can be joined by some of the mortgage industry's most infamous, and perhaps in some cases even famous, if you can include Twitter, to discuss some of the most pertinent issues facing us all in the mortgage market. It's time to get your cups of tea and homemade cappuccinos and macchiatos at the ready, or maybe even something stronger. It is Thursday afternoon. Well, it was the last time I looked. Anyway, I'm joined this afternoon by 7 of the industry's best. My warm welcomes to come out of the COVID-19 cold go to Ian Andrew, Intermediary Relationship Director at Nationwide Building Society, Sally Laker, Managing Director of Mortgage Intelligence, Martin Stewart, Director of the Money Group, Alistair Ewing, Chief Executive of the Lending Channel, John Ahmed, Chief Executive of Panel Manager Movin Legal, Simon Jackson, Managing Director of SDL Surveying, and Sebastian Murphy, Founder and Head of Finance at Network JLM Mortgage Service. Now, all of their biographies have been on the holding screen and the marketing emails, and so if you do want to find out more about them personally, do look them all up on LinkedIn, or in some cases Tinder. Just remember to swipe left. Now, this is a live broadcast, and we might be having a few technical issues, but we will be trying to take some live questions, but we do have some to start us off. If you do submit a question which is not answered, the team and I will, along with our panelists, seek to get it answered privately, if not on the Mortgage Introducer website itself. So now to the first question, which has come from quite a few separate people and organisations, but we're going to take this one from Ashley Olson, Director of Property Finance Lender, Magnet Capital. He wants to know whether the panel thinks that the whole mortgage and finance industry was prepared for the current crisis. Ian, let's start with you. Have you any ideas? Is Ian here? Maybe not. Martin Stewart, was the industry prepared for this?
No, but then I don't think the country was. I don't think as a species we were. The world was. No one was ready for this at all, Robyn. And that's the unfortunate state of affairs that we kind of find ourselves in today. 4 weeks ago, I was sat in a restaurant in France, and now I'm sat in my living room with hair that's rapidly becoming something from a 1970s rock band. But no, it is what it is. It was a fast-moving situation. It still is, I think, to a degree. The dominoes started to fall in many different directions at a rate of knots that no one could get in front of. I think we have to commend ourselves for still being here in many respects. I think the industry is very, very resilient. There is a lot of parallels between where we are today and maybe sort of 2008, where we all learned some valuable lessons. So I think it was a surprise. I think, but as a species and as an industry, we're very, very adaptable, and I suggest that we've adapted very well so far to where we are today.
So, what are your thoughts on this? Could the industry have been prepared any better?
Is that me? Sorry. Probably is the honest answer. The industry could have been prepared better, but I don't think that's unique to our industry. As Martin said, you know, pretty much everybody's been impacted by the impact of the pandemic. Now, having said that, most parts of the industry are in fact functioning today. There are estate agents who are doing things like video tours. We've got brokers writing business. We've got underwriters writing business at lenders. Valuers, albeit doing less work, but they're doing desktops and giving values back to lenders, and conveyancers are conveyancing. So as an industry, we have responded quickly to the impact of the pandemic and got ourselves to the position where we can write some business during the lockdown. So, you know, I think the industry probably wasn't well prepared for it in advance, but I think we work in a sector where people roll with the punches and people have got on with their normal day jobs.
Now, you talk about rolling punches. John Ahmed, how have you found it from a Movin Legal point of view in terms of what happened, what is happening?
I mean, exactly the same there as what Simon said, Robyn. We've got quite a big pipeline, and we're still seeing completions. We're still seeing business come in, albeit greatly reduced, simply because the loan to values, the products, etc., is getting all moved around. So yeah, I mean, I think the industry is responding very well to it. And, you know, we just got to keep our head down and just keep doing what we're doing. One or two cancellations, but not a huge amount by any means.
Sally Laker, what are your thoughts on the current crisis, and where could we have been a little bit more prepared, do you think?
I think the mortgage industry as a whole is constantly changing, so we're always expecting change. However, I don't think we were expecting something that was going to be such a global, not only in financially mortgage, it's also with health as well. So it was almost the perfect storm. And I think what it has is made us start to think differently, because it's shown up the areas that perhaps haven't been quick off the mark on technology, and where we are now is so different. If this had happened 10 years ago, I think where we are today, we've been able to work from home and quickly put processes in place. But I think in our whole mortgage transaction piece, it's shown where the game stoppers are. And certainly there's been a lot more activity in trying to increase using desktop valuations. But I think that face-to-face valuer definitely has been a part of stopping the cases that are in the pipeline that might have to stay there until that returns. So I think it's showing that there's parts of the process that really could do with being more linked to technology, and it's shown us where they are.
And Alistair, what are your thoughts on this?
Thanks, Robyn, and good afternoon all. Last, hopefully not least, yeah, I think being prepared for the current crisis, I don't think any of us would have been prepared for a crisis of this magnitude, even with everyone's business interruption plans being fully implemented. From our own personal perspective, we had a business, like many of us did, that actually went bust in 2009. So have we learned lessons from the previous crash? Yes, we definitely have. We've got far less excesses in the business now than we had before. We've got no debt as a business, and we reckon that we can ride the storm for maybe 2 or 3 months. However, 2 or 3 months, and after that is anyone's guess. Having a little bit of cash in reserve was certainly key to survive the last crisis. This crisis is very different, of course, because there's not a liquidity problem in general. Certainly with the main banks, there's plenty of money to be lent. So it's a different problem than before, but certainly not prepared for this, but hopefully in better fettle than we were in the lead up to the crunch back in 2008.
Sebastian, we just had a question coming from Sargrana as a follow-up to Ashley's question. Do you think our industry was perhaps better prepared than other industries in terms of expecting the unexpected?
Well, to echo Sally's words, yes, you know, we are in an industry which always seems in a constant state of flux, with new regulation being thrown at us all the time, and you know, kind of new rules to adhere to all the time. So I think we're very good at adapting. I think without a doubt, on the front line, intermediaries and brokers, you know, are perfectly set up for this type of scenario. Most of them do now work remotely, or if they're in an office, their clients now they see remotely, and even if it's by, say, Zoom or some kind of video. So we're definitely better placed than most other industries. And you know, if you look at where we are compared to, say, 2008, you know, with the benefit of product transfers and remortgages, and the benefit of living through the ghastly Brexit situation for the last 3 years, we've all got used to working in a mutual marketplace where 70% of it's remortgage and refinance anyway.
Now, a common thread for questions coming in this afternoon they do all relate to 2008 and its aftermath. I've got a question here from Eleanor Broadhurst of Bayer Financial. She wants to know, what do you think the long-term effects will be of COVID-19 on the mortgage market? And do you think it will have lasting effects similar to those of 2008? It could be a tricky one, so let's go back to Martin Stewart, our broker in the Zoom room. Martin, what do you think? Will anything be different this time around?
I think it could be completely different this time around, because this is a much broader church that's been affected by the crisis, whereas 2008 it was concentrated in the lending markets specifically, and there's still an active market, you know, 8 and 09, and purchases still still went ahead. So I think the issue now is that everyone's been affected by this, and also the speed of it, which I mentioned earlier. When you think back that the credit crunch started in 2008, but there was a year between Bear Stearns falling down and Lehman Brothers falling down. And then we had a year of plateauing, then a year or two of getting out of it. But this has been, as we said, 4 weeks in, and we're probably still all learning as to what the repercussions of this will be. I think the employment market will probably be a bigger indicator as to how you may be affected in mortgages. If consumer confidence disappears for any length of time, or if there is a rise in unemployment, then yeah, you might see that this could be an issue that we have to sort of accommodate, and it will be a new normal that we will find. But as we said, we're all very resilient and we will adapt. And I think that will be key going forward. Those that can adapt to a new normal will survive.
Sam, what's your take on the current situation? Are there any comparables to 2008?
There are some, although it's very different. This time there'll be some long-term effects of things like social distancing beginning to impact face-to-face meetings. That could carry on to the end of the year and beyond. And it'll become, I guess, in most workplaces, culturally unacceptable to turn up with a cold or the flu, as most people have been doing for years in the recent past. And from our perspective, with surveyor inspections, certainly as the lockdown comes, they will look different to how they used to, in that we'll be asking people to socially distance and impacting the way in which we inspect differently to what we've done in the past. But I guess if you think back to 2008, some of the things that happened then were lots of businesses went into administration, but this time the government's offering a significant amount of financial support. It's not available to every business, but it's available to lots and lots of different businesses. And we've gone into this particular pandemic where lenders, networks, brokers are much, much better capitalized than they were before. And the level of regulation means that those businesses are also much better run than they were before. And you couple that with the government financial support, we ought to see a lot more businesses surviving through the period. Although, as Martin says, people will have to adapt to the new norm. Hopefully, we'll see innovation and technology advancements move much more quickly as people try and get themselves into a position where they can operate with that new norm as it goes ahead. And hopefully, we won't see the reduction in house prices that we've seen at the end of every recession as we kind of go through. Partly, we've been stymied in the last 2 years as a result of a lack of stock in the marketplace. It's a horrendous thought to think about, but there are lots and lots of people who've been locked in their houses with people they no longer like. And so those houses might well come up for offer. There's been a significant number of people who've lost their lives as a result of COVID-19. Those properties will come onto the market, and people's financial situations will be different, which will force some properties out there. Whether that increasing stock will reduce house prices or not, I think it remains to be seen. But that could be one parallel back to 2008 and other recessions that we've seen.
John, Ahmed, what are your thoughts on this recession? You've been through quite a few recessions in your lifetime. What's your take this time around?
I think this one's completely different to 2008, obviously, except for the reduction in transactions for everybody. Finance at the minute isn't a problem, so the lenders have got money to lend. And like Simon said, we were better prepared for it. Everybody was better prepared for it. So I think when they reduce the lockdown, when they start easing the pressure, I think what will happen is people will start to purchase again. The market will start to move. We did a survey not so long ago of all of our clients, and everybody said, Robyn, that they just wanted to get shifting and get moving as quick as they could. So the appetite's still there. It's just obviously it'll come out slightly different with social distancing and how everybody goes about it. But the appetite's there, and people do want to move. They want to get on.
Alistair, a new appetite. What do you think?
Yes, I think it's impossible to predict what the long-term effects might be, but some of the things that we do know with some degree of certainty, the mortgage market is probably split into two distinct camps. We've got the mainstream mortgage market, which consists mainly of the traditional banks. what we call the balance sheet lenders. There's plenty of capital in that part of the market just now. So there's certainly not the liquidity issues that we had back in 2008. However, what's become the specialist lending markets, which clearly I represent, is very different today, because they're dependent on the capital, the wholesale markets for their funding. And already quite a few of them have withdrawn, hopefully just temporarily, but they've withdrawn from the market just now because of lack of funding. And that is going to, that's probably going to have a knock-on effect to the people that were already, let's call them disenfranchised borrowers, but people now that have lost jobs, that have been furloughed and maybe will get laid off when they can't get back out of furlough, and people that are working in sectors that are just difficult just now or impossible to get lending. These people are going to depend on the specialist sector probably more than ever. So we need to make sure where we can that those markets are funded and that the liquidity is there.
Sally, Alistair's made a couple of interesting points there, and I guess one of the things we may see or will see in the future is this whole rush of COVID-19 mortgage prisoners, which will inevitably come to the fore. Do you have any thoughts on that, Sally?
I think that this is why brokers exist. This is a time, and I think there always will be a time, that people need advice. They need to know where they can go, what they can borrow, and furlough was something no one had ever heard of 6 months ago. And the interesting thing about this pandemic is that everybody knows about it. With 24/7 news, internet, social media, everybody knows about it, can find out and understand what it's all about. And I think particularly with the initiatives that the government have brought out, people are able to find out about it within minutes of it appearing on the news, because there'll be something on the website. So I think the knowledge is a huge difference between 2008 and where we are now. Brokers are mainly, I would say virtually all, entrepreneurs that have run their businesses, many of them for many years, and those that went through the credit crunch learned to remodel their business and make it appropriate for the market change then. And we can see that now. They're already looking at remodeling their current business model, concentrating more on remortgages and product transfers, life assurance, all the things that they can speak to their clients about. And more importantly, we know that the initiative of the 3-month payment-free period, they're able to tell their customers how to go about it, what to do. I think they're in a good position to advise customers and get them through this. That's what they do. And I think that the great thing we have this time is technology. The fact that within a short space of time, most businesses, if not all businesses, had transferred the whole operation to working from home, which in 2008, I think would have been very doubtful. So technology's been our friend this time. And I think that it will change the way people work. Social distancing, no one really thought about that before, but I think they will think about it for quite a while. So I think brokers too will have to look at possibly doing video chats and embracing that, because people are going to be, as someone said earlier, if you wouldn't turn up with a stinking cold and expect someone to see you now, you'd probably be very careful to make sure they want to see you anyway. But if they can do it in this way, it would make life easier for everybody.
You're right. Understanding something like coronavirus is a lot easier to understand and people to get their heads around than maybe the global financial crisis of 2008. Sebastian, what are your thoughts on this?
Yes, I mean, I really do, concur with everything Sally has said there. I think there will be some real positives that do come out of this as well for our industry. I think we've highlighted some slightly weak points in the chain, issues which we've known about, which have not really addressed. And we've seen obviously a big step forward of automated valuations and desktop valuations, but there's still a lot more work to do there. And perhaps the role of surveyor will go back to a much more specialist role than just, turning up to do, in most cases, a bog standard mortgage val. I also think that intermediaries will become a lot more streamlined. I think that if people aren't embracing technology, they certainly will do going forward. And going forward, we can see that we can make this industry better through all the mistakes that or perhaps the stuff we weren't prepared for going into this. As I said, with maybe looking at the conveyancing piece, looking at the surveys, and also just looking how brokers and intermediaries look after their clients.
Technology is so much better this time around, and unfortunately, sometimes it still doesn't work. I've just heard that unfortunately Ian Andrews' Wi-Fi has gone down, and unfortunately he won't be able to join us this afternoon, which is a shame. So our next question is actually from Rob Jutt, and it would have been quite good to get Ian's views on this. Rob's the Chief Executive of Brightstar Group, and earlier this week he called for the immediate and indefinite suspension of all house price indices until a meaningful number of property transactions are able to proceed. This follows the suspension of the Rightmove house price index earlier this week. So Rob wants to know, does the panel share his view? Martin, let's start this one with you.
I think Rob makes a really valid point there. You can't take an average if you've got no data. And I think we're going to be entering a quarter, at least 3 months of having some very, very thin information with which to base some facts upon. So I think Rightmove themselves have already ceased with theirs, and it would have been interesting to hear Ian's point of view with Nationwide. That's always a respective indices. But yeah, I do think there is scope. There's no point reporting on something that you can't really validate. And until we navigate this crisis, until we get back to some sort of transaction normality, whatever that will look like, who knows? But we can't really gauge house prices until we've got something to work from. I will suggest though that I've always been led to believe that honesty is the best policy, and we shouldn't sweep bad news under the carpet. And if when the indices are relaunched, if the news is not necessarily palatable and one that we want to see, we should still be supportive and embrace that information. So whatever the indices are, they could well drop at some point over the next 3 to 6 months, and that is what it is.
Simon Jackson, what are your thoughts on house price indices?
I agree with Martin completely. There is no reason to issue a house price index when there is insufficient data for it to be deemed accurate. It's a logical thing to suspend it, and I understand both the Halifax and Nationwide ones have been suspended as well, pending the increase in transaction numbers to make it a more realistic number. In truth, there oughtn't be too many firms relying on that house price index for anything significant, other than kind of a directional piece in terms of what's happening. A national house price index has rarely reflected what happens in local markets for some considerable time. Locally, you can have very different changes to what happens nationally because London has a big impact and all those sorts of things. So local agents and local surveyors have always had a much better handle on what's happening in the local area, and talking to them has always been a much more logical thing than just following what the national house price index says. It's true, we might see the impact of the pandemic having a negative impact on house prices, and Martin's right, we need to be really clear if that's true. There's no evidence of that yet, so we're not seeing wholesale purchase transactions being cancelled whilst people are going to offer lower amounts for them. We're not seeing houses come onto the market at lower than normal market prices. So there's no indication yet that house prices have fallen. I know there was the Office of National Statistics data out yesterday where the headline said house prices are coming down, but actually if you read the article, what it was a slowing in the growth of house prices, not a reduction in the overall prices themselves. And that's been true for a while. There's been a fairly stagnant market, and right now what we're seeing is a really extreme version of that stagnant market where there's very, very few transactions. We just need to be honest with ourselves when the market starts to move about what's happening with those prices, and make sure that all elements of the sector are aware of where it is and what's happening.
John Ahmed, is that something you would agree with?
Yeah, I mean, I can see the common sense in what everybody's saying, but personally, I think the prices should be tracked all the way through for whatever little data is there. what that does for us on a historical point, when you look back at it, you'll be able to see what the dips and what the information is and when it was and how it occurred. And that obviously that might help us going forward if anything like this happens again.
Sally, what's your take? Should John's suggesting that data should just continue to track it no matter what? Would you agree with that?
I actually do, because I think we really can learn lessons from the past, and we kind of need to know in the future what we were thinking, and was that the right way of thinking, and how we came to that conclusion. I agree with Simon that I'm not sure that people use it when they're looking to buy a house, and when they're looking around, they'll fall in love with something and it'll be in their price range and they'll go for it. But I think it is quite useful to have stats, however, with a caveat that the numbers are too small. I absolutely agree with Rob on that, the numbers are small. But even if they are small, it's quite good to have that reference point to go back to. And we thought this was right, and actually it wasn't because of this. So I think there is a good point there. And I must say that I agree with Simon's point that after people come out of this, the other end, and they've perhaps had 3 children and they've been in a house that they were wanting to move from in the first place, they're probably, if they're in the position to afford it, they're probably going to look for that house and go for it, because they will want to do that having had 3 months to think about it, or however long it is, they'll be wanting to get that house. So I think that will be looking for the right house, and if they can manage it, they probably won't be worrying too much about what the index is if you're moving.
Alistair, that Sally's made some good points there. And at the end of the day, are you going to be that bothered about the price of your house or the price of the house you're moving into if you just want to move anyway? What's your take on that?
Yeah, I think the wider market in general, I would feel fairly safe disagreeing with Rob Jupp, because I'm not in the same room as him today. But he does make a valid point about the limited number of transactions. So I'd probably slightly disagree with John, and I think there probably needs to be more transactions so we can get some meaningful figures. So if Rightmove, Nationwide, etc. are thinking of suspending the figures of snowed indices, it's maybe not a bad thing, but I would say you can sometimes have too much media. Obviously, Robyn, yourself, present company, excluded from that, but you can have too much media, and the media sometimes the mainstream media certainly do a good job of talking the market down, so they use these indices to bring the market down sometimes. And I just think sometimes we can maybe have too much media.
Indeed. And Sebastian, have you got any thoughts on this?
Yeah, I mean, we're worried as a business of the kind of negative speculation, and that's all it is at the moment about house prices. We've not seen any reduction in house prices in the area where we are. We're just outside London, and we work predominantly in the London market. In fact, obviously, we've seen, as the ONS have said yesterday, a kind of a Brexit bounce with prices, and that's was very strong in January and February. So I think it's early to say. I think what we are going to see, obviously, as soon as we come out of this to any degree, regrettably, we are going to see a lot of properties come to the market, and they are going to be from people who have lost their jobs or regrettably have died, and that will probably give an untrue reflection of where prices are for people which have to sell no matter what. So we just have to be very careful with the data, and we need to make sure that the mainstream press don't hijack all the kind of negative figures and use it to bring the market down, because at this moment in time the market's suspended, and I think most people are quite comfortable about that because nobody wants their equity eroded away.
Now, we've talked a little bit about technology, and that really is coming to the fore at the moment. We've had lots of questions about how readers think this is going to help both change their lives in the future. I've got a question here from Pai Mazardi at Niche Mortgages, Southwest London. Now, he says that there has been much talk about technology, but fundamentally, things have still not changed a great deal from, say, 2 to 3 years ago. Does the panel think that the lockdown will change the core principles of mortgage broking? And I've got something that's come in from Stuart Gregory as well. It's similar to this. It says, with more brokers working from home and keeping in contact with clients remotely, does the panel think this will alter the advice world in the future? Simon, let's kick off with you. Technology and AVM's valuations, they have come to the fore of late. What do you think? Is everything going to change going forward now?
Undoubtedly, it is going to change going forward. All technology, including AVMs and desktops, are enablers of something, either quicker, cheaper, or better decisions, really, in our world, in this kind of surveying space. AVMs and desktops rely on transactions, and a limited transactional market for a period of time could impact their accuracy over time. But I think they're still very valuable, and there probably needs to be more use of them. I can't remember who on the panel said in one of their earlier answers, but I completely agree. We need to get surveyors going to see the properties they need to see, the more difficult ones, the listed buildings, those that need more attention and more expertise, and the simpler stuff should be going down an automated route. Now, if any of my my colleagues from other surveying firms are one of the 192 people dialed in, they'll probably be screaming at the screen. Because somebody in my position wouldn't normally say, actually, I think a load more stuff should go automated. But I do fundamentally. We send surveyors out to properties we don't need to do surveyed inspections for, because, you know, my children could put a value on it based on the comparable evidence that's available. And so we need to make sure that we get them doing the right stuff. Now, I think for a period of time, that we'll have surveyors actually adding value in the way they need to, because there'll be limited transactional information, and surveyors working with local agents to put values on property will get us over that period. And then as the new normal returns and we get more transactions in there, I would like to see more AVMs and more desktops, leaving surveyors going out seeing the properties they need to see.
Okay. Martin, I'm going to come over to you. So one of the things Pia mentioned was whether this lockdown will change the core principles of mortgage broking. What do you take from that?
I don't think it will change, Robyn, because those core principles haven't changed for 30 years, and they shouldn't really change for the next 30 years, because the core principle is doing what's right for the clients. So the job of the broker is going to be no different going forward. What will change is how we actually do the job in the background. So I've maintained, and trust me, I'm the world's biggest Luddite out there, I've maintained for a long time that we should embrace technology, but technology should be there to do the heavy lifting and the advisor does the heavy thinking. So long as that stays in balance, then the brokers will be around and it will work alongside technology, because, you know, as far as I'm aware, you cannot automate common sense. And a lot of advice is nothing more than common sense. So all the time there's a human being there just overriding and helping that client make that final decision, that's great. So yes, all the AVMs, all the AIPs, all the APIs, whatever you want to call them, they're great. They make our life easier, but it won't take us out of the food chain.
Sebastian, can you see the face of mortgage broking changing going forward?
Well, I think, you know, to answer the question that came in, I have to kind of strongly disagree. I think we've seen so much more technology in our industry in the last 2 years than we ever have done. It's been such a kind of a swift upward curve. And if you look at the tools available now to intermediaries, such as affordability tools, criteria tools, you know, we can offer a much better service and quicker service for our clients, much more accurate, and also much more efficient to brokers. We spend much, you know, less time per client now, and get a much more, I think, a much better result with better lenders. There was at one stage, I think, you know, go-to lenders for every intermediary, every broker, and the use of these tools has definitely changed lender spread for the better. So, you know, I have to disagree. I think, you know, technology is here to do the heavy lifting. You know, I agree with Martin completely. I think brokers now are needed more than ever, and I think that actually the technology piece, especially with lenders, with the use of AVMs and say automatic income verification directly with HMRC, where you have say Nationwide, Santander, HSBC, which are using this at the moment, and people like Coventry, is working really, really well, and it's making us more efficient as an industry.
Alistair, what's your take on this? Sorry, Alistair, what's your take on this?
Yeah, I mean, I think the very fact that we're all here today in the Zoom room, all working from home, that surely validates the fact we're all embracing technology in a way we probably would not have predicted 6 or 7 weeks ago. But I think some of the specifics of the technology, and as Sebastian said, I think we're already embracing a lot of the improvements and efficiencies that in the mortgage broking lending market in recent times. Some of the stuff maybe more peculiar to the specialist lending market, second charges in particular, would be the use of API technology, which is coming in the mainstream market. It's not quite there yet, but it is coming with some of the bigger lenders. But there's a substantial chunk of business now being written in the second charge market coming across APIs, which vastly improves efficiency of the application and improves the end user service for the product. And also lenders at UTB who are using the Nevo app to validate people's identity. I think these are already happening, and I think will continue, and there's probably a need to continue things more as this crisis continues.
John, what's your take on this?
Yeah, I mean, I concur with everybody else, really. I mean, technology is there to make the job easier, make it better, and it will keep evolving. Having said that, so will brokers. Brokers will keep evolving. They do all the time. And, you know, it's all about the relationship, the client-broker relationship for me. I think that personal relationship is strong, and I think brokers will use technology to enhance the job. But the technology won't necessarily, you know, instantly replace the job, if you know what I mean. So, yeah, technology is a great thing, but so is the broker with the relationship and understanding of the client.
Technology has been a game changer. Sally, you mentioned before how it is really helping. Are you seeing a massive change amongst your members and how you go about the work?
Yes, I do. I also think we've got to look at today's customer. And when you look at most people, as you're walking around, everyone has a handset that they're looking at. They do shopping online, do absolutely everything on their phone. So they are more now likely to want to do something by video conference and online than they have ever been before, because people now fill their time with so much, and they want to be able to look at a mortgage, look at what they need to do at any time that suits them. And I think this gives brokers the flexibility to see more clients and with less expense of traveling up to London or traveling around the country and less long meetings that you've got half the time driving there. Now you can be more efficient with your time. And actually, you can probably see more customers because they can see you at times. Obviously, most people are working during the day. They don't want to have to take time off. They want to try and see someone and sort this out in the evening or time to suit them. And brokers are well placed to do that, especially if they're able to work at home, which we've proved that most of them are. And so I think it makes it a more efficient process and a more enjoyable process for the client because they can manage it in their own time. And I think, you know, if you'd said 10 years ago to most people in their homes, oh, we want to do a video conference with you on your PC, no one would, they'd have to have some special gadget to do it. But now, well, they can do it on their phone, and that's what they would expect to do. So I think we've got to make sure that we're keeping abreast of that and working with today's generation. But still, there's that ultimate piece of advice, which I think is so necessary, because now there are so many products, there's so many things to consider. And so I think advice is more important than ever has been. But I do think there's a piece that's missing in the chain. And I think that the fintech side of things need to look at that end process of the mortgage, where certainly land registry need to be online, and so that end process can be speeded up, because that's what holds up all of the mortgage transactions. We can get from dip to offer pretty quick now, and then it stops because we've got all the other bits that come in between, from the conveyancing and land registry and all of the numerous pieces of paper that have to be not faxed, but scanned and sent through. I think there's a lot that could be done electronically there that could speed up the process completely. So that's where I think the next innovation needs to be.
Oh, that's good to hear. I've got a couple more questions that have come in. Here's an interesting one from Adrian Knott from the Adrian Knott Financial Partnership. Now, I know that's Adrian's quite a prolific high net worth broker in London and the south of England. And he's had lots of queries about the rise in the cost of PI insurance for brokers and also the squeeze on specialist lending borrowing requirements in the light of COVID-19. So what does the panel think the industry will look like in the future, I guess is what he's getting at, both in terms of PI and that so-called squeeze on specialist lenders. Sebastian, let's start this one with you.
Yes, no, that's a really interesting point. And, you know, unfortunately, we've been in the thick of this in the last couple of months with renewing our own PI insurance. And, you know, we're a business of 20 years. We have very, very few complaints. And we've only ever had one claim on our PI insurance in that whole period, which was over 7 years ago. And this year, our premiums has increased by over 350%. And that was, in the end, something we almost welcomed, because with 2 days to go, we were still struggling to get cover. And so this is potentially a huge problem facing our industry going forward. Lots of firms won't be aware of this yet, because obviously their PI isn't up for renewal at this moment in time, but it's a very different landscape. And you know, I've spoken to Robert Sinclair at Amy about this today, and you know, perhaps a way forward is us speaking to some of our partners within the industry, like Legal in General, like Aviva, like some of the big insurers we do lots of day-to-day business with, and try and create industry-specific PI policies, because this is going to cause a lot of pain, not only for kind of medium-sized firms like ourselves, but for directly authorised brokers, and it could potentially be another nail in the coffin for smaller one-man band and DA firms.
Another nail in the coffin. Now, Martin, Stewart, you must have some thoughts about this.
Yeah, and I do empathise with Sebastian. We've had to renew a PI policy for one of our brands recently, and it was a new firm. It's only done 2 years. It's very, very vanilla, but still we had to fight right up to renewal date to get a policy in force. So I think there are wider issues for the whole industry that we all need to be aware of. That there is nothing wrong with being directly authorised, but you have to go into that with your eyes wide open. The regulator is not the person that's going to put you out of business. The person that will put you out of business will be a lender, removing you off a panel, or it will be the PI policy that you can't renew. And that's where I think we all need to be going forward. And I think this actually will focus a lot of people's minds across the industry, networks and large nationals, and in the DA space, that the whole industry needs to raise the bar on professionalism. And it might be won't be the end of broking, but it could certainly be the end of some brokers at the lower end, whereby it's more of a lifestyle business. And I think what we should see, particularly in the DA space, which is pretty much our model, is that there will be a dash for scale. I think that will be very useful for everyone going forward, particularly from the lender's point of view and from the regulator's point of view, and also from the consumer's point of view. I think we will see 20 large condensed channels of distribution within the industry at some point in the future, and PI will be one of those main drivers for that.
Alistair, do you have any thoughts on that in terms of condensed distribution going forward?
Yeah, I mean, I'm not convinced that a scaled up DA model is going to be much different to the current network models with the ARs. I'm not sure if you scaled a DA firm large enough, it's just going to be mirroring a large network. But my own sort of personal experience with the PI stuff is I'm not seeing yet what the other guys are seeing. Our policy was renewed in November. We had about a 12% rise, I think, on the previous year. So you always expect it to go up because it never comes down. But nothing too onerous there. So we're a fairly small firm, but I'm not seeing the issues the other guys have so far. So I've really got not much else to add on that part, I'm afraid.
Sally, do you have any thoughts on this from a mortgage intelligence point of view, and obviously the services that you provide to your?
Yeah, I do. I think I agree with Alistair that I would have said, if you were asking me, that increase would be around about 15 to 20%. That's what we've our approach would be. That's what we think that's the going rate. There's also from smaller businesses directly authorised, I think there's been a bit of an increase in that excess that they would have had before. Previously, around about £1,000 excess, we're hearing that's been bumped up to 5,000. So I don't know, that's what we've sort of been getting some feedback on. Yes, and as a network, we obviously arrange the PI for our members, so we do that. But of course, we're equally subject to increase. But as I say, we're looking that that's around probably 15 to 20%. But it's those smaller businesses where that excess can be quite chunky if they do have to come up with a claim. But my advice would be on that as well. If they are looking at a claim, get in touch with the PI company straight away and work with them right from the get-go. Don't leave it. Just get in touch and work closely with them.
Stephen as well, Simon, sorry, do you have any thoughts on this in the sort of PI market going forward, the issues people are going to be facing?
Yeah, PI has been a difficult market for well over 12 months. Prior to that, Lloyd's of London did a review of all of its insurance lines, and PI turned out to be the second worst performing insurance line that they had. And that has led to a lot of the firms repricing up, changing things like deductibles, and so excesses have gone up. There's been the introduction of something called an aggregate excess, which sort of sits above there, and lots of changes to the structure of the policy. And difficultly, I guess, the way the PI insurers work is they don't have a product for brokers and a product for surveyors and a product for lawyers and a separate one for accountants. They've got one bucket that they pour everybody's PI into. And at different times, different sectors are feeding out of that bucket. Currently construction, I guess, in the last 12 months has had a few more claims than other people, but and some issues, I suppose, with COVID-19 could fall under a PI policy, and we'll see more claims coming out of there. And what that's done is to make the policy much more expensive for everybody. And that's been the case for a while, and it's probably going to be like that for some time. The insurance world would call it a hardening market, which just means it gets more expensive for everybody buying the insurance. Our experience and what we've said to people who sit on our surveying panel, it is the best way to get a good deal is to make sure the underwriter understands your business. And the way to do that is to get your broker to get you in front of the underwriters. Don't just let your broker sell it for you. And the last thing you should do is just fill in the prop form in the way it's presented to you and send that back, because it doesn't bring to life your business or the risk management procedures that you've got in place. It won't necessarily make it much cheaper, but you will get cover on the back of taking it on in that way.
And John, Ahmed, what would you say to those concerns?
Yeah, I would agree. I mean, from the legal perspective, lawyers have got quite expensive professional indemnity premiums that they have to pay. There's a lot of risk around that, because if a client's money or a purchaser's deposit goes missing, that's where all the claims has been over the last few years. So, I concur with Simon about it all going into one bucket. I actually, through working with the lawyers, I deal with a couple of the PI providers and some of the underwriters like Penn as well. And there's been some horrendous claims in the legal section over the last couple of years, and that's led to professional indemnity premiums rising. Would be nice, wouldn't it, if we could section off each channel and have a look in each channel to see exactly what is happening. That would be a step in the right direction, but I don't think that's going to happen. I think Simon's absolutely right on that. It all goes into the same bucket, and that's assessed on risk and what claims is coming out of it, and that's about it, really.
I just want to take one of the live questions that has come in here from Ewing and Stewart as we're coming to the end of our hour. Ewing wants to know, if social distancing continues until 2021, many people will not be able to carry out their normal jobs. Now, he says this could cause a rise in requests for extended payment holidays with extra pressure on lenders themselves. Now, how do you see this playing out? John, can we stay with you on that one?
So, I think we'll get, as a society, if social distancing continues, I think we'll get very, very used to that very, very quickly. Funnily enough, earlier on this morning, I have to admit I went shopping with me missus, and it's funny because over the last few weeks when we've all been locked down, people have been kind of feeling apprehensive about walking around you or pushing out the way. I don't see that now. I see people sort of embrace it. They're not needing to make excuses about it. I heard a young guy in the queue last week at Tesco's talking to some young lady, and he said, "Look, you're a bonny girl, but I have to keep the social distance." So I think it's all changing now. I think people are getting used to it. Will it bring pressures inside businesses? Undoubtedly, but I think businesses are already coping with that. You might not have two people sitting across a desk coughing and looking at each other. The desk might be put in the corners of the room if you want to suggest that. But I think we'll get used to it pretty quickly, to be honest with you. I don't think it'll have a massive knock-on effect. I think it's down to the effect will be down more to unemployment if that tends to rise, etc.
And Sally, how do you see this playing out? Do you think we will see an extension to mortgage payment holidays, perhaps?
I think it's difficult to say. When that announcement was made, I know from the lender's point of view, the number of cases that came through was huge, and dealing with that was quite significant. I think initially people were very quick to apply for it. I think when they realised a bit more about the detail, that some, as I understand, changed their mind after they'd applied for it and thought, perhaps we don't need to. But so I'm not sure whether that will happen. But I do think that the social distancing will stay with us because people are going to be more careful. I think I know some of the larger operations before there was complete lockdown were having half their staff working in the office and half working at home for 2 weeks and then switching it over so that they were alternating, also cleaning the entire premises before the next half came in. So that's one way of doing it if you've got huge staffing levels and you want people in the office. Other businesses can have worked completely from home. And that was something that we did fairly quickly once we realised that lockdown was coming. We were able to enable everyone to work from home, which is, if you'd asked me 2 years ago, I would have been a bit reticent to think that. But I think most people have done that and done it quickly and surprised themselves at how efficient it can be. And it goes back to this thing about the customer again. Does the customer want to go into a busy office with lots of people that they don't know, or do they want to go around to a shop premises, that perhaps a broker premises that they don't know and they know they're going to be in close proximity? I think this is where technology comes back again. If you're behind a screen and you can do everything as much as possible online, I think that might be the preference partly because of the social distancing as well. So I do think it's going to take time for people to feel comfortable at being close, and so it's going to be interesting to see, how things progress and whether we do forget quickly or whether we keep that worry in our minds about how being sat close to someone. And I think there's been so much written about how it can be transported across with, you don't realise how easy it is. And I think that's the thing about COVID-19. It's so easy if you're in contact with someone for that to be transmitted. If it's gonna go to you.
That's great. Now our hour's finally up. No, nearly up. I just want to go to this last question here. This is a global crisis, and we are all in this together. What business advice would you give to those watching today? Maybe start with you, Alistair. What advice would you give to those out there?
Simply, don't let the heart rule the head. We need to protect our businesses going forward. So we've got functioning businesses, we've got jobs for the staff, but we mustn't let the fear of the unknown get in the way of doing good business. So don't let the heart rule the head would be my closing message.
Martin, what about yourself? What advice would you give to those watching today?
Very simple. It's the same lesson from the credit crunch. Just keep on keeping on. Activity will be your greatest friend. It doesn't really matter what it is, so long as you're doing something. It will be a question of being realistic about your pipeline and your income for the next 3 months. but then plan for 6 months' time, because that will soon be with us. So don't necessarily go looking for a client, go looking for an introducer, go looking for a mentor, go looking for an influencer. Just do something, be busy.
And Sebastian, what are your thoughts?
Well, I think, you know, we've had to learn the lessons that we've, you know, and to look at the marketplace we've been in for the last 3 years with Brexit, and like how much our market has changed, and that's created lots of opportunities, which is keeping brokers and intermediaries going at this moment in time. We need to keep speaking to our clients. We need to keep offering them advice, even if there's not advice which is going to turn into immediate business. We also need to keep speaking to our staff, and we need to make sure they're happy, they're confident, they understand what we're going through, and the sacrifices we might need them to make, albeit large, albeit small. But you know, it's about communication. We are all in this together, and so I really do agree with Martin. Looking forward to not next week, but maybe 6 months is definitely the key, and just keep looking every day. Start every day with a really positive approach, and you know, make the most of opportunities that come your way.
Simon Jackson, sorry, what advice would you give to those watching at home today?
I agree with everything everybody said so far, but I would say listen to your clients, take this opportunity to develop your business along so that you can support their changing needs, because they'll probably have changing needs coming out the back of this, and don't just try and re-establish the business you had on the 23rd of March.
Mr. Ahmed, how about yourself? What advice would you give to viewers today?
Well, I concur with everything that's already been said by everybody else. But you know, the key thing is, you know, keep your relationship with your staff, keep your relationship with your clients, and stay focused on your business, because you know we will all come out of this, and just be ready for it.
And then finally, Sally, what words of wisdom can you instill to our viewers?
Well, definitely keep in touch with your client, as everyone has said, because that's so important, and they need you right now. They need to know perhaps what to do. Check your model is relevant for where we are today, and make sure you've changed it, tweaked it so that it can manage today's world. And also, if you're part of a network or part of a club, make the most of the information that's available there. We've put a huge amount of information on our COVID-19 site, and I think that there's been so many changes from the lenders and product providers, lots and lots of changes. So you need to keep up to date on that. And this is where any network or any club are there to help you and give you that information and try and make things easier for you. So yes, keep up to date, and yes, look after that pipeline.
Well, thank you very much. Thank you to our panelists, and thank you at home for watching. Again, it's been both interesting and insightful in what are truly strange, challenging and uncertain times for us all. Well, that does come to the end of this special Mortgage Introducer Live Roundtable, and I do hope you've found it useful. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, and remember, stay safe. Goodbye.